mate. Look, it's my call
Hey,
sign.
man.
I was hoping to do dressing gowns, but you said no. So
Ben's bat signal is a beanie.
that's it. Mates, we are talking not a scenario, but we're talking a concept that's come up in the last couple of scenarios, which is you just breeze over, Corey. You need to have 50 grand in the bank. You breeze over the fact you need 100K in the bank to do this. When are you going to actually talk about the reality of how hard that is and what that looks like? So, Corey, we're covering deposits. Tell us about kind of the pressure of deposits and how this becomes the wall for investors and first home buyers and all these guys.
Yeah, I think fundamentally is discipline of spending. I look at my life when I was younger. I was a spender. You're not taught how to spend. You're not taught how to budget. Schools don't do that. And I think the people that win and buy property early have been those people that understand the fundamentals of money, understand the fundamentals of how much they have coming in and then what needs to go out and what's necessary to buy and not buy.
Mm.
The reality is a deposit demonstrates what risk level you are to a bank, but also your discipline around sound money management and likelihood of default, right? So you may be one of those people that obtain $100,000, investment or gift from mum and dad. Well, it's going to come and catch up with you. So we want to talk about some of the disciplines of money today and also some strategies on how to build that up, because there's a lot of people young, we've helped some first home buyers who are in their early 20s that have bought their first home. And that's just simple strategies around managing money. So it is difficult. Once you're in your later 20s, in your early 30s, once you start having kids and have bigger bills, that's when it gets tough. So we might have to talk about some of those strategies. How do you get there? How do you start building that? But when you're young, it's about disciplines on spending.
Yeah. And look, we talk about this a lot, especially because we've been talking about first home buyer and first home investor. Basically, you'll run into this every time. The best time to have started saving and the best time to have invested, the best time to have bought, the best time to have done anything was 10 years ago. Because you look back, house prices were this and blah, 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 and you can look back and regret it. The second best time is today. Start now, and in 10 years' time, you'll thank yourself.
Correct.
And the reality is, if 10 years ago you'd save $100 a week, you would have 50K. And so, if even if you're a young tucker and just, 14, 15 went, I'm just going to go mow a couple lawns this weekend. I'm going to get that cash. I'm going to put straight away. I'm not going to spend on lollies and shoes and the stuff that you do. Now, there's not a lot of 14-year-olds who have that wisdom and foresight, but if you are out there, they do exist.
They do.
And so, but if I had someone who was, 13 and said, hey, look, if you saved $100 a week, for 10 years and you could buy a house, would you do it? Most of them say yes. It's about then actually helping them do it. So the reality is, a lot of people don't realize, and they're not really aware of the figures that you need to achieve. And so a lot of people are at that square one point. And so we're going to talk around James, that first home buyer. I want to go and get my first home. I'm a single person. Now, first home buyers are different because they generally need to buy where they need to buy. Like, I live here, I work here, so I need to buy in this area, which generally drives up the price, right?
Yes.
So why is that? Why first home buyers versus first home investors end up paying more?
Reality is they end up paying more because buying where you are going to live is not just a logical decision, it's an emotional decision.
Yeah.
Right? You're committing to potentially 10 years in one place. And quite often the desire to be in a certain place outweighs the financial decision. So you end up paying a little bit more for it, right? But a whole bunch of benefits, government benefits come up along with that. A logical decision, and by the way, no decision's right or wrong. The emotional decision could be the right decision. But the logical decision is, well, I can't buy where I want to live, so maybe I need to consider a lower purchase price, an investment, a deal where there's going to be equity growth, and I can buy the dream house in 10 years. So there's two different decision-making processes that have to take place, and no decision's a right or wrong decision. It's really where you're at the time.
Yeah. So I'm going to share my screen real quick, Corey, and we'll have a look at some of these figures. So if you want to buy a 350K home, and you need a 20% deposit, which is going to be 70K, you'll need about 5%. Now we're talking here, no stamp duty exemption, first home buyers, but you might get that. That's out there, that exists. But your funds to complete is $87,500. Now, a lot of people are going, well, where am I going to buy a $3,500 home? Look, we just talked to a bank who, they're talking about regional Australia. And if you live in regional Australia for 12 months, you can buy in regional Australia. And so you might go, hey, look, I am going to move town or something like that. That might be what you want to do. So 350 is cheap, but it's probably a regional Australia kind of level of price. But you can see that to save $87,500 in 10 years is $168 a week.
Very achievable if you're in your mid-20s, right?
Oh,
that's cutting down, going out a couple of nights a week.
Yeah. 500K here. You need that $125,000 mark. So you're looking then at $240 a week. And then 750 is kind of dream home territory, anything up there. And so you're looking at $360 a week, $480 a week. And that's to avoid paying LMI and those kinds of things and those extra costs. But at the end of the day, these are achievable figures, but it's a highly regimented, very strict life. I've seen people do it, but I know the people who do it, and they are animals. They are focused. They are, I won't have friends for the next couple of years, or the friends that I do have, we're going to walk in the park and not go out. Like, it's kind of those kinds of things. What you see down here is a variation of the 10% with LMI. So do you want to explain what that means, what the 10% means, LMI? Just talk through that real quick.
Yeah, so basically LMI, that's an abbreviation, and all lenders call it something different. Some lenders have different names for it, but it's a term called lender's mortgage insurance. What this is the bank is essentially charging you their insurance cost on the risk. They're assessing you as a high risk of default, right? Because they're saying, well, you can't demonstrate a 20% deposit, so we're going to charge this insurance. We're going to make you pay for our insurance, which covers the risk of default and potentially them having to take the property away. It is a good strategy to get into a property. If you're buying in Sydney, you're buying in some regional areas, it's usually about 3% that you get charged, and it gets capitalized into the loan. That usually outweighs the growth in property if you're going to stay there for 5 to 10 years. But you just got to be aware that you're going to have to pay it. It's going to hurt your feelings. It's a way to get in, and it's probably an opportunity cost to get into the property. And it can be a reasonable approach for an investor as well to have LMI charge, especially if you're going to add value to the property. So that's
it's interesting, Corey, because the amount of people we talk to who have credit cards, because they believe by having a credit card and pay it back, that the banks will look more kindly at them. But the banks actually look more kindly at savings than credit cards. In fact, credit cards are often a detractor because they go, well, if you've got a credit card, it means you don't pay cash for stuff. And they kind of, some banks can even punish you for having credit cards, and it will affect your serviceability.
Yeah, look, we've had clients that have, $50,000 in credit cards, but.
All right, bit of a tech issue there.
Yes.
You were saying that you had clients with $50,000 of credit cards.
Credit cards. So I don't mind people having a small credit card to use it for credit history. It's not as critical as it was probably 10, 15 years ago, where the story was get a credit card, build your credit file up. It's not. Banks actually love a clean credit file with nothing happening. It's not a bad thing.
They'd much rather genuine savings.
Correct. They'd much rather look at the character of client than But it's not a bad idea to get a small credit card. But we've had a client that had we've actually had some that have had $300,000 worth of credit cards. But we've had some with 50, but they're only spending, they'll go, oh, Corey, I only spend $2,000 worth a month and I pay it all back straight away. They've been fairly smart. They're using it for their expenses. But the bank is going to account for the full $50,000 being used and you having to repay it. Roughly at 3.5%, they'll assess. You're looking at, $1,700 being taken out of borrowing capacity. That's half a repayment for somebody looking to buy a 350.
Yeah.
Well,
the amount of times that we've seen credit cards kill deals, we've had to go back and say, cut your credit card and you'll get this loan through. So, look, the final one, I just need to reshare my screen, is we've got over here the government assistance. So people who only need a 5% deposit, and there's no LMI at that point, and there's no stamp duty at that point. You only need 20 grand saved. So if you want to do that over 10 years, that's $39 a week. Now, I'll point out at this point, if 10 years ago you just saved $40 a week, the amount of people in Australia, I think the average Australian saves about 5 cents a week. I heard a stat once. That was a little while ago.
Wow.
Yeah, that's the average savings of the Australians. But had you just saved even $50 a week, started 10 years ago, which is just good financial practice, you would be in the position right now to take advantage of this.
And I want to point something out, Benny. A lot of people, right? A lot of these people in the early 20s think, when I make more money, I'll do that.
Yeah.
I want to say something. You are your habits, right? So if you're making pittance and you're saving nothing, when you make more money, you'll save nothing. Even if you're just saving, let's say you can't afford $50 a week, even if you're saving $10 a week now, you're going to build those habits when you do start making money.
Yeah, 100%.
So I want to point out that, like, we're talking about building actual habits into your life that can contribute to you building a good life. So $40 a week, guys, it's two Macca's meals. If you're a young adult, you're definitely doing that already a week. Put it into an account that you don't have easily transfer access to. Put it somewhere.
Yeah.
Just automatically when you get paid, it's the first thing that gets transferred out.
Yeah. Now, amount to save, for the deposit for a $500,000 house, $28,000 in 10 years. It's $50 a week, basically 55. To do that in 5 years, $108. So the reality is, had you been doing this already, you'd be in a great position right now to take advantage of this. Will this be around in 5 years? Who knows? I don't know if 5 years ago people were thinking, hey, look, the government might come and save me thousands of dollars with a policy. But the reality is that we've got options here that even in 2 years' time, you could really turn this around with some focus. Now, the key question from here is, well, what do we do if, how do we actually save this deposit? And we've got 8 things we want to share with you that will actually help you get this deposit. So first one is, and look, all of these are not the answer. It's not like you do one of these things, you're going to have 50K. A lot of these are going to save you a couple of K a year. But if you do 3 or 4 of them, it's probably 10 to 15K a year. And that's very quickly, 2 to 3 years away from actually being at the point to get this. So first one is just, and you mentioned it before, lower the purchase price. So many people want to get the dream home first. What do we mean by lower the purchase price, and why is that?
Just reset your expectations around what you can afford. Now we're probably diversing away from the first home benefits, but buy a property that you can afford. It's as simple as that. If you can't buy a $500,000 house, buy a $350,000 house. You may not be living in it, you may not like the house, but I tell you what, in 5 years you're going to build it, have a fairly good equity position to capitalize on, which will then translate into a next step house, right? When you buy your first car, you're not driving a BMW. Sometimes you're driving a 1989 Laser, and it's yellow, right? So you got to start somewhere.
Yeah. And you buy that $350,000 house, it's going to grow in price, like you said. But if you paint it, put some new carpet in, and just keep the lawn nice and do the gardens and keep them weed free, you can actually add a lot of value to that property as well. And so it's not just the price of the growth of the area; it's then the price of what you put into it. So
Correct. Yeah.
you make 50 to 100K over 5 years, which is really not crazy figures at all.
Not at all.
That's going to get your deposit back that you put into the initial investment plus the growth of the property.
Correct.
You're now ready to go for your next property. The second thing is invest in property, which kind of takes us back to Jess. What do we mean by that?
Well, Jess realised that she lived in Sydney. She can't buy a house for the price that she could afford in terms of her borrowing capacity. So she thought, well, you know what, I'm going to rent with some friends, stay at home. And I'm going to buy a regional investment property or something that can have some growth in it, and know that I can then capitalize on that growth and sell it, or capitalize it and buy another property. Ben, you're an example of it. You've just come out of 2 investment properties, and now you're in the dream home family. And you bought them very cheap, and you've sold them very well.
Bought in areas people said don't buy there.
Yeah, you did very well, and you did a couple of things to create growth, but really the big growth was the market, and the market will continue to go up. There'll be dips and dives, but long term you'll win if you're not buying in a mining area. And now Ben is in a significantly priced property with low debt, significant equity if he wanted to go do something else, and in the dream house where he can start doing things to it to create more growth. So
I can definitely attest to that one. The third one is increase income. But no, we'll leave that. Increase income. So this is probably a bit short term. Some people kind of look at this and go, how long can you do that? But it's super effective. The amount of people who go, right, for the next little while, maybe 2-3 years, I'm going to drive Uber on a Friday, Saturday night, or do a casual job on the weekend, just lose my weekends. It's probably not sustainable to be working, 6 days a week, 2 jobs for years and years. But
you might not do it every week, right? You might once a fortnight mow 5 lawns, and then the other might stop, and the 5 lawns gives you another $200. Which is
a side hustle business is a great idea.
Asking for a pay rise. We've just got a client now that I was just doing his processing last night. He actually were in the middle of processing it, and he provided a new payslip with an increase of $10,000, and it took it up $400 a month in borrowing, right? So we won't say the names here, but increase your income, ask for a pay rise. 4 beers at the local pub, ask to mow lawns or cut trees down for somebody, whatever it might be. Do something that you're not reliant on your day-to-day expenses, and it's just cream on top of what you already can save.
Or you could take on more days. You could upskill, go and do a TAFE course in the evenings, and you could get a pay rise that way, or you could get a whole new job which pays better. The other thing is, often people can do as a good little side hustle is just Facebook Marketplace. Go full Gary Vaynerchuk, and just go to garage sales and buy cheap stuff and sell it. Like the amount of people who flip and make some really good money. Number 4 is downsize your life, which is one that hurts, but you kind of mentioned it before. What do we mean by downsize your life?
Yeah, look, you might be in your mid-20s and you've bought this amazing car and you love it, but you think you can't get anywhere. Well, it's probably costing you $800-900 a month. Maybe it's time to sell that car and buy a small get around, and not look cool. Don't buy the new shoes that come out. Don't get the new iPhone straight away. those type of things. I would say pull out your bank account for the last 12 months or 6 months and look at what you're spending on, and you'll see quite quickly that there's a lot of DoorDash, menu log.
We'll get to that. We'll get to that.
Oh, right. Yeah.
Yeah, we'll get to analyze the spending in a second. But downsizing, you've got to like and I'm known for this one. This is what I did when I was early 20s. Is I had the Mitsubishi Challenger, the big 4-wheel drive. Loved going up the beach. Loved doing that, hanging with my friends. And I sold it, and I went and bought myself a Toyota Corolla that was like 10 years old, and I drove it into the ground. Literally, it started falling apart. And because it was a cheap car, it was cheap to run. It was $100 a week back then in petrol for the Challenger. This one was only $40 a week, and I started to decrease and downsize. But you sell your car that's 20K and go and buy something 5K, and it's going to get through. This is 15K straight there. If you downsize your rental, you might be renting for $600-700 a week in a beautiful home, but just go, for a season, we're just going to go and rent somewhere a bit smaller, and it's not going to be as comfortable, but it might be $100-200 a week that you're saving. It's not really always enticing to downsize your life, to go and sell your surfboard. Hey, I only need one surfboard for the next couple of years. Or, hey, look, I'm not going to go on too many ski trips. I'm not going to go on too many holidays for the next couple. Just downsize your life. Sell the power.
Eating at home a bit more, maybe having some cheaper meals. We're human beings, we accumulate a lot of stuff. If I go out into my sheds or my backyard right now, there's stuff I can sell that gives me a boost to my bank account. So it's getting rid of stuff. If you haven't used it in 6 months, within 6 to 12 months, you probably sell it.
Yep. Now the next one is guarantor deposit. So we did cover this a little bit last week, but you can go to someone, kind of get a deposit rather than go guarantor on the loan. Get a deposit that they write a letter saying you don't have to pay this back until you sell your home.
Yeah, correct. So this is a gift we're talking about, right? So it's the bank of mum and dad we're talking about here. It's mum and dad are potentially giving you either an early inheritance in advance, or they are, saying this is a gift, and if you ever sell the property, just pay us back. That's one of them. The other option is you can actually leverage their property potentially as security towards the purchase, which allows you to borrow 100% of the purchasing amount. I don't mind the bank of mum and dad, right? The reality is a lot of bank of mum and dads help, and a lot are happy to. I'm not a huge fan of using the security that they have in case they want to do something else.
In
the long run, and it could wrap you up into something where you have to sell. That means them downsizing, and all of a sudden the next property doesn't have enough security, and all of a sudden you're left having to sell. But bank of mum and dad is a place that can help as well.
Yeah. Now this is one you talked about before. Number 6 is analyze your spending. So go and get your bank accounts, have a look at them.
Yeah, have a look at your bank accounts. It's amazing when you actually look at your bank accounts. And I know my wife gets up me when she looks at it. She goes, "We're spending so much on this and that." You don't know. Food's a big one for everybody, guys. Everyone takes the lazy way out. We're all guilty of it. We had a client recently, like, "Oh yeah, my living expenses." It's a young lady living at home, and she said her living expenses were $300 a month. And we were a bit skeptical, and we start looking at the bank accounts, and sometimes multiple times a day we're seeing DoorDash, then we're seeing Netflix, then we're seeing online shopping, all these type of things. You don't realize how much you actually spend.
And the banks will look at that, by the way. So
absolutely,
because the banks do.
And we have to as well. We have to demonstrate to go, well, what's this person's character in spending like? Are they a sound financial mind? It's gone are the days where you get cash out and go grocery shopping and you actually know what you're spending. It's really easy to spend, and you don't know where your money's gone. Look at the last 3 to 6 months and really categorize. And some of the banks actually have this categorization already within their apps. Really categorize what you're spending on and what you can pull back on. There's going to be a significant amount of extracurricular or non-discretionary or discretionary expenses, that are that are not hardline and required for your life that you can pull back on.
Now, to avoid ending up on Triple J from young people, telling them that there's a mortgage broker out there who's patronising them, and to avoid triggering the boomers out there as well, this does get down to things like Netflix. And I remember watching a video from a online. She was a young girl going, "Oh, all these boomers out there saying Netflix, cancel your Netflix, and it's going to help you get a deposit, but $15 a month is only like 180 a year. What's that going to do?" Yeah, but if there's like 20 things that you spend $15 on a month, that's actually a fair bit of money. Over 3 years, that's about 11K.
Guys, we're not asking you to get rid of stuff and stare at a brick wall for your entertainment. If you've got 7 subscriptions that are stream based, cycle them. Okay, well, I'm gonna watch Netflix for 2 months and then I'm gonna cancel it and go to Disney or whatever it is. Cycle. You don't need to watch the new series that comes out that week. Read some more books. Figure out ways where you can have entertainment cheaper. So that's what we're saying. We're just saying that don't stop this, but we're saying for a period of time, this is what happens. And you might go, "Oh yeah, I ordered DoorDash for lunch and dinner," but then it ends up being $60 because the delivery driver's taking something. It adds up.
Yeah.
$60 can get you 2 days of food, rather than 2 meals.
Yeah. Now, number 7 is get your saved money working for you. There are so many investment strategies out there. If you're just saving the money and putting, you got 10, 20K sitting in a savings account, it's probably it's not working for you, right? So what are we talking about getting it working for you?
Yeah, look, the last several years, savings account hasn't been a great idea or a term deposit, but at the moment, while the interest rates are high, there's some great opportunities around getting 6 to 7% return on money. If you're putting in that $200 a week that we're talking about, it's going to do fairly well for you while this interest rate period's high. So if you can't afford it, if you are in that position, take advantage of it while the interest rates are high, because a year ago, 18 months ago, it was less than 1% for savings accounts. Now we're looking at 6 or 7, so take advantage of it. Now, I just want to preface, we are not financial planners. We are mortgage brokers. Yeah. Some of our clients have done this via ETFs and the share market as well. There's a bit of risk associated there. Sometimes it's down, sometimes it's up. So that's one thing. And there's also
if it was all to go bad and you've got your whole deposit for a home in there and lost it all, you'd feel pretty ordinary. Yeah, so make sure you do.
Yeah, look, put enough in crypto and shares, whatever you want to do. Put enough in there of the 200. So I'm saying put $10 in or something. Put enough in there that you're not going to hurt if something happens.
Yeah.
So put enough in there in that way. You could also, guys, I'm going to say invest in business. So it could be buying a lawnmower to get extra cash on the weekends. That's another form of investment. Make your money work for you. So reinvest into yourself. That helps you build up more money faster.
Yeah. And finally, go joint venture. Now, we talked about this kind of guarantor, but what do you mean by get into it with mate? How's this different to how's this different to guarantor?
Well, guarantors, bank of mum and dad providing the cash for you to then move forward and buy a property. Joint venture is 2 things. It's either both of you bringing your deposit together, so it means getting in faster, and also combining your borrowing capacity. In some cases, right, it's the other way around. You might have a mate that's got serviceability and a little bit of savings, but somebody else who's got a significant amount of savings, and that could have been because they received their gift from mum and dad, or it could have been that they received an inheritance. So you can strengthen each other's weaknesses by combining and going in. If you're 50-50 on the property, but you'd have to have some type of separate deed or legal agreement to say what's the ownership piece.
Yeah.
Is it going to be 70-30? Is it going to be 50-50? Is it going to be 60-40? And make sure that that's reflected on the title, and make sure you guys have a clear financial agreement I say take that one with caution because it's great to go into stuff with a friend, but you sometimes, in my opinion, the friendship outweighs the money side. So make sure you've put your legal foot forward, and good friends will do those things to make sure that it doesn't come in the way
Yeah.
of having to divide things later. So agree to what ownership stake everyone has.
Now, in saying that, I got a mate who did this with a good mate of his, and they made 50K in about 6 months.
Yeah, absolutely. Just make sure you know what your expectations are of each other, and document it.
Well, look, there's 8 ways to save a deposit. There's details on what you need to be saving per week. With that, if you want to take any steps forward, we are happy to help. Have a chat with you, talk with you about some strategies, anything. Like we said, we're not financial advisors, but we are keen and passionate about helping people get into their first home. So give us a call. If you got any questions, hit us up. We'd love to answer any of the questions that we get. And coming up in a couple of weeks, we're going to be talking some new people, some new scenarios, meeting some new people. We've got the RBA's decision in not long. So we don't know if interest rates are going to go up, stay the same, or go down. So there's a lot happening in the next few weeks. So stay tuned for the future videos. Thanks, Corey, for your wisdom again, and we'll catch you around.
Thanks, guys.